Dear friends, welcome to our monthly video on markets and investing. As you all know, we had the elections and there was a lot of volatility around the election, especially on the day when the results were announced. We had a significant drawdown and then the markets have recovered and recovered very, very smartly. And obviously, one of the reasons that the markets have recovered very smartly is that investors used the correction to actually come and buy in. And as you all know, that we have been consistently for the last several quarters explaining you that the markets are not irrational, that they have gone up on the basis of a very fundamental reason that earnings have also compounded and the markets have also compounded in step with earnings. But one other very fundamental factor is the flow of savings. And I'm sure all of you would have read and heard that this market's being driven by liquidity. And so, like everything else, we deep dive into data and try to find what the facts are and not go by myth, right? So we busted the first myth for a long time to come, which was that the markets are expensive. We said no, markets are not expensive on the whole because earnings have compounded. Now we want to bust another myth that it's liquidity which is driving markets. And when we look at the data, we will find some very interesting trends. So today we will talk about who are the constituents, who owns the companies that are listed on the equity markets, how those constituents have moved, how much are domestic savings coming into the equity markets, and what are the trends that we see going forward. And therefore, at a very high level, when we look at what has happened in the last 5 years, and we've looked at data from 2019 up until March 24, we see that promoters in India, which typically used to own somewhere between 54 to 55% of shareholding in companies, and we've taken all companies which have a market cap in excess of 500 crores. And the way we did this study is that we looked at number of shares instead of looking at values, because sometimes values may not give you the right indication. But if you look at number of shares, the promoters were typically owning somewhere between 53 to 54% of their companies at a very aggregate level, all companies with a market cap in excess of 500 crores. And as things stand today in 2024, that holding has come down to roughly 50%. So which means that the promoters have used the rally in the stock market to reduce their holdings. They have been net sellers in the market, right? FIIs, on the other hand, used to own about 12% of the shares in India, and their count has pretty much remained very steady at 12%. So then who has bought the shares that have been sold by the promoters? If you look at the DII shareholding, which is the domestic institutional investors, which is your insurance companies, the mutual funds, the pension funds, etc., their holding has gone from about 14-15% to 18%. And if you take the retail and the HNI, which is the domestic investors, their holding has gone up from 10 to 15%, right? So over the last 5 years, what has happened as the markets have gone up is that promoters have sold in general, FIs have remained steady, and it's really the domestic institutions and the retail investors and high net worth which have actually participated and bought those shares. And this also includes the participation of DIIs and domestic institutions in new IPOs or new companies that have got listed, or new offerings that have happened. But it's really promoters selling, and which may also include the government, and DIIs and retail participating and buying. So really the story of the last 5 years in the Indian markets have been that it is the flow of domestic capital which has really gone into the equity markets. And this is important because the wealth that has been created over the last 5 years is all now created by domestic institutions and the domestic public. And this is very, very important. We also looked at just the mutual fund data, right? Because we've been hearing about how SIPs have gone up over a period of time. They were like 3,000-4,000 crores a month. We are now almost reaching 20,000 crores a month. And if you look at that data over the last 5 years, if you look at just the equity AUM of mutual funds, that's gone up from roughly 12 lakh crores to 35 lakh crores, which is a CAGR of roughly 24% over 5 years. And if you look at retail plus HNI participation, their share in the domestic mutual funds, their share of that 35 lakh crores is 23% compounded. So that's broadly moved in line with how the domestic mutual fund AUMs have grown. But actually the net, what is most surprising when we looked at the data is that the share of corporates in the mutual fund, equity mutual fund AUM has actually gone up from 2.5 lakh crores to 8.5 lakh crores. And that's compounded at 30%. Though it's much smaller, it's about 1/3 or 1/4 of what the individual investors own. But the share of corporates in equity mutual fund has actually compounded faster than what individuals have put in. And when we looked at that data, the only thing that we can conclude here is that over the last 5 years, Indian companies, and these could be even private limited companies, it could be smaller companies and even larger corporates and conglomerates, have actually generated massive cash flows and profits. And they are sitting on reserves and cash flows, some of which has also come into the equity markets. And the reason why we say this is because it's not just the domestic retail investors who are participating, it's also the cash flows which have been generated by companies which are finding its way into the equity markets. So we believe that when private capex really takes off, maybe some of this money will go out and will go into actual projects, which is a good thing. But for all the big noise that we see about domestic liquidity driving equity markets, again, if you look at the data of gross financial savings, and what is gross financial savings? You take the nominal GDP, you multiply it by the savings rate of the country, you get gross financial savings. And gross financial savings have been growing. They are roughly at about 30 lakh crores today, but only 2 lakh crores out of the gross financial savings is actually going into equity or the markets. So it is still a very minuscule amount of savings out of the total household gross financial savings that is finding its way into the equity markets. And therefore, if we think that the current bull market has been fueled by domestic savings, then what it means is that there is still a significant headroom for domestic financial savings to come to the equity markets. We are just at the very early stages of this transformation of savings going away from physical assets to financial assets. And if we look at the 2023 numbers, even today, a large part of physical assets continue to be part of the savings pool of investors. So we have a very, very long runway. More than 50% of savings even today, maybe 60, and the last figure is even up to 70% of financial savings is still in physical assets. We reckon a lot of that in the last few years has been in buying a house or a property. And if we look at within the money that has gone into financial savings, I think in India, our average holding of cash and deposits versus, let's say, putting money into equity markets or insurance or pension funds is still very, very low. For example, in the US, within the financial savings bucket, almost 85% goes into equity or equity-like instruments. UK, it is roughly 70%. Taiwan 61, Korea 54. In India, it is still 40%. So 60% out of the financial services bucket is still into deposits or is held as cash. And therefore, as I said, even while the last few years we've seen a lot of money flow into the equity markets, we believe that we haven't seen anything yet. The amount of money that can potentially flow into the equity markets is much, much bigger. And we did some modeling. Currently, roughly about 6 to 7% of gross financial savings come to the equity markets, which is somewhere in the region of 2 to 3 lakh crores. But if nominal GDP starts to compound at 10-11%, gross financial savings have been compounding at 11%, we believe that even at 8%, let's say by FY27 or by 2028, we will see almost 6 to 7 lakh crores potentially that can come to the equity markets. That is 3x of what the current annual run rate is, right? And therefore, this forms a very strong fundamental bedrock for a long-term bull market in India. One other interesting thing when we were looking at this data was that in the last 5 years, while financial savings have come to the equity markets, even faster than that has been that individuals have taken a lot of loans for consumption. They could be for house, property, it could be for auto, it could be for any consumption item. And in the last 5 years, financial liabilities have risen from 5 lakh crores to almost 15 to 16 lakh crores and have compounded at 22%. And I think that's also one of the reasons why the Reserve Bank of India in the last 6 months has become very conservative and have been dissuading the fact that they are very uncomfortable with unsecured loans growing at a very rapid pace. And therefore, we believe that all government policies are now aimed at, they do want credit growth. Obviously, consumers will take credit for consumption, but they don't want something compounding at twice the rate at which the savings are compounding. So if savings are compounding at 11-12% and if financial liabilities are compounding at 22%, that's almost twice the rate. So we believe that there is a moderation, and we are seeing that in the data, that credit, consumer credit is beginning to slow down after all the steps that the RBI has taken. And we need more of this savings going into more productive assets, not just physical assets. Physical assets still form a very large part of the savings. We believe that incrementally over the next, as India continues to be younger, our demographics is better. We believe there is a wall of savings that will come to the equity markets. And that makes us very confident that this bull market has very many legs to continue, because the potential amount of domestic savings that can come is humongous. And it also feeds into the question where a lot of investors come to us and ask that should we put money now, should we wait for the markets to correct? Well, in a bull market there can always be corrections, we cannot deny that. But as we have seen over the last few years, that every correction has been used as an opportunity to invest, and we believe that this is a very strong foundational bull market enabler, that there is a wall of savings that is waiting. So if you wait endlessly, somebody else is going to come and invest. And therefore we believe that while one should be cautious, we should definitely not spend our time and effort trading in futures and options and derivatives, because bull market corrections can be very sharp and severe. However, we should not shy away from investing in the markets, because this trend is just at the beginning, and we have decades and decades where there is still a large amount of financial savings which is waiting to enter the capital markets. With that, I end this month's communication, and by next month, hopefully when the budget is out, we will talk about what are the implications of some of the policy moves in the budget. Until then, thank you and goodbye.